Hey folks, David Frost, my strategic forecaster here for another episode of Common Sense Market Analysis on Tuesday, August 11, 2015. Here's a daily chart of the SPY, and it was a pretty good bloodbath out there today. So the market went down pretty hard, but the question is this a correction inside of a larger trend that's still moving higher? Or is this the further beginnings of a bigger down move? And we're going to try and answer some of that tonight. But I got to tell you, if you're trading this market, okay, and I know some of you out there are day traders and swing traders, and there's all kinds of traders out there. And what you need to understand is that this is a range-bound market right now, okay? It's not like when, for example, I was telling you folks that this was most likely a low, and worst case it was a little lower, but we're going to get one more rally. This is a different market right now where from day to day, we could be up 20 points in the S&P, we can be down 20 points in the S&P just like today. And, it's a range-bound market. You just don't know what's going to happen day to day like we do sometimes. That will clear up. But right now, you can expect more of the same. This is nothing other than choppiness or choppy behavior inside of a tight range. I want to show you something interesting. Okay, and we're going to talk a little bit more about the markets, but I want to show you things that I'm looking at both ways. Oh, before I even do that, as evidence, okay, let me go over to the E-mini because I always talk about the 2078 number. Look what happened today. Let me even go to the 10-minute chart, and I want to show you the importance of 2078. Now, earlier today, the market was way down here, okay? And then all of a sudden, at the end of the day, we start kind of firming up from down here, and we start, I don't want to call it a rally, but we start moving higher. And what happened? The market recaptures the 2078, and you can see here where it fought the 2078 for 1, 2, 3, 4, maybe 4, so it's 30 to 40 minutes, let's say. It fought the 2078, broke down, tried it one more time, failed, and then it recaptured the 2078 towards the end of the day, the last hour of the day or so. Now, what's interesting about that is if you just pull back the chart to the daily chart, okay, you can see here, look at the importance of the 2078. Now, you could say it was 2077, 2076, 2080. It doesn't really matter. The point is there's an area in here. My calculation comes to 2078, so that's important to me. Okay, but there's an area in here where the market thinks is very, very important. And what I will submit one more time that I've been telling you for days and days and days is above 2078 is more bullish. Below 2078 is more bearish. Now, the other day we got a fake out. We closed below 2078. And then yesterday, look what happened. The market ripped higher. Now, what you need to understand is this morning there was a piece of news that came out. China's unpegging their currency by 1 point some odd percent to the dollar. And therefore, everybody got worried. The market sold off. The news I don't really care about. It is what it is. Okay, you can make of it what you will. Sooner or later, somebody will decide that's positive news if the market goes higher. That's not the point. The point is that the market is susceptible. It's almost like walking on a thin sheet of ice across a pond. And, at any point in time, you can break through. And that's really the market we're in now. So I want to show you a couple of other things. I'm going to show you different things that I'm looking at, okay? So let's start with the daily chart, and I just want to show you this. Okay, actually, let's go to the spider chart. Okay, we'll do the same thing I was going to do. And I know this chart's messy, but this will be okay. Let me do this. Okay, let's draw a trend line that goes from the low connecting other lows. Now, it's subjective to where this trend line should actually be. Should it be from, the opening, the close, or the close of this candle, or the pivot low of this candle? It's not important. Let me explain why. Okay, And then you take another one, I'll take it from a like number, right? I take it from a pivot low, and I'll take it from a pivot high up here at 213.18. Remember that number, okay? And we'll just draw it like this. And this is another point I want to make. Okay, you can see how the trading range is wide and it starts to get narrower, okay, and get narrower. So what I'm suggesting to you is that within the next day or so, we're probably going to start back up into this area. We're certainly, at least unless we break down, probably recapture the 209.72. That's over here. Okay, that's this purple line here, okay, or higher, all right? And maybe we get to the top or to the underside of this trend line. Maybe we don't, but you can see how the market is trading in a range, but the range is being drawn, or the trend lines are being drawn by the range that's narrowing. So my point to you is, what happens, let me just try and pull back this chart a little bit. Okay, what happens as we get into this area here? Okay, well, it's obvious. We're going to break out one way or the other. Okay, we're either going to break up or we're going to break down from this, what's really called people can call it a pennant formation, triangle. I don't really care what you call it. What I call it is a narrowing range, and once this gets to the end, time's up. You're done. It doesn't have to get to the end, but time will be up, and it will break down or up one way or the other. It's going to either do this, okay, or it's going to do this, okay, one way or the other. Could it break out of the range before we get to the end? Of course it can. I'm just showing you the things I'm looking at that are important to me. Now let me show you something else. Now today looked like a bloodbath. It was, for all intents and purposes, during the day, certainly worse than it finished. We recaptured the 208.40 in the spider, and we recaptured the 20.78 in the E-mini contract. But let me show you something else. Let me take these off for a second so the chart isn't as messy as it looks. There's a lot of stuff on here, but I need them. I need this stuff because A, it helps me trade, and B, it helps you. You know, you can write down these numbers, refer back to the video. You know, look what happened yesterday. We went right up into this 210.54 and then broke down. When was that? Yeah, that was yesterday. And then we gapped down today, and look what happens, okay? The 208.40, you can see where it fought it. But let me show you something else. Let's talk about Fibonacci for a second, okay? Anybody that thinks Fibonacci is nonsense, watch this, okay? Sorry about that. It always happens when I have the recording on. I just don't know why. Now watch this. From the pivot low on, what was it, Thursday, okay? This pivot low was from the 7th, okay? And what was the 7th? The 7th was, I just need to know the day. Yeah, that was Friday. Up to the high of yesterday. And what happened today? We came down, we started to stall out, ironically enough, at the 208.40 roughly, or the exact 618 retracement was 208.30. So you can see what happened here. The market spent, and this is a 60-minute chart, so it spent part of the hour down here, the next hour oscillating, okay, closed the hour on the number for the most part, okay, and then part of the next hour here. So I don't remember, we can look at a 10-minute, in fact, to be sure, but I think it was around 40 minutes or so, maybe something like that. Down in this area. So you can see where we spent 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11 candles. Okay, so 6 candles is an hour. Okay, so over an hour in this area. Let's go back to the hourly chart. So on one case, you can say, well, maybe we're still going to get up to the 212 because, by the way, that still is a possibility. It still comes up on the calculator. The number is the number. All that means is it's a possibility. It does not mean we have to trade up to that number. It just means it's a possibility, and I don't have any higher number, 212 to 212.50. I don't have a higher number that we would trade up to yet. If we got up there, I might come up with a higher number, but right now, that is the top end of my target, okay? But don't misunderstand target. It doesn't mean we have to get there. It just means that's the top end. That's a good shorting territory unless I tell you otherwise when we get there. But remember, this is not an easy market to trade. Let me pull back the chart one more time. Okay, I'm going to take off this Fibonacci retracement. Well, let me just go back to the hourly one more time and complete this conversation. So from low to high, we made a 7.5 retrace. Now, the normal Fibonacci retracement is technically 76.39 or 76.4. That's what most charting softwares will give you. I change it to a 2.5 retrace instead of a 23.6, and I change it to a 7.5 retrace. And frankly, I do that because those numbers actually work better. There's no rhyme or reason other than over the years, I just would rather go with a quarter. The 382 is a real good number, 50%, 3/4, and then 100%. It just works for me. It seems to work better, and it really doesn't matter one way or the other. You're talking fractions anyway. So did we just make a 7.5 retrace, which is considered a deep retracement from this low to high, a deep retracement, and then maybe we continue higher? I do think over the next day or two, you will see some upward momentum in the market because we got oversold today on a very short-term basis, compressed, and they'll come out with some kind of news tomorrow that will spark the markets into an S&P 10-point rally or something tomorrow or the next day. Maybe tomorrow's just a pause day, one way or the other. Maybe we're up a couple of points, down a couple of points. We'll see. It's the type of market. Let me take this off and go back to the daily chart. And I just want to cover this one more time before we move on. This type of range-bound market, okay, is a very difficult market to trade. It's near impossible for me to tell you that yesterday was going to be up this much and today was going to be down this much. Anybody on the correct side of the market, there's an element of luck, because for you to know that today was going to be down as much as it was down at the lows from yesterday's highs is really, there's nobody that could have told you that. Nobody's that good. I'm certainly not that good. I can tell you where a sustainable low is coming. I can tell you that this was going to be a pivot high. We talked about this was going to be a high. All that kind of stuff, yes, because there's other factors involved. But when you're chopping around in a very narrow range, up one day, up 2 or 3 days, down 2 or 3 days, 4 days, up, down, that's a very difficult market to trade. So my point, and I'm going to close it on this, and then we'll move on to gold. My point is, be very careful. These are the type of markets that if you're not confident and you're not sure of a trade you're taking that you're going to be right, and I don't mean sure 100%, I mean the normal stuff that we talk about where, it's a good level. You're 75% sure. I'm giving you the level that should be resistance or should be support. You know where you're wrong. You know where the stop at is. Unless you know those type of things, then your money is better served in your pocket until the market clears up. We're going to break out of this triangle pattern here that I drew in for you before. And when we do, it's going to be powerful. And I can tell you with quite certain, or with a lot of certainty, I should say, that if it breaks on the downside, which I suspect it will, we may go up first, but we will get to the downside, and we will get to 202 or lower, and we will get there shortly. We will get there either whether it's this summer or shortly in the fall. We will get there, and as evidence, I will point out, and those members that have been around for a while, okay, I mean several months. You remember what I was saying back in March, April, May. I said the market's going higher, but make no mistake about it. When the summer gets here, everything's going to change. And guess what, folks? Here's the beginning. This is May, okay? And remember, in May, I was still telling you the summer is going to be choppy, okay? Remember, I was going to say the summer is not going to be the same. This is the middle of June, and look what happened starting the middle of June. We went down here, okay, back up, back down, up, down, up, down. Okay, so this is the summer. This is the summer I've been talking about, okay? We will go lower, not to say we won't get up here. That's still a possibility. I'm not going to call it a probability. Right now it's a possibility, but it's more of a probability that we're going to get down here. Okay, we just need confirmation, and the market's playing with the 208.40 and on the E-mini contract 2078, and it can drive you to drink, and I don't drink, but I might start drinking pretty soon as long as they keep playing with that 2078. All right, let's move on to gold. Sorry that the market took so long, but nevertheless, I think it was worth the discussion. I'm trying to give you a rational conversation and also warn you of what's going on so you can look at it objectively like I do, okay? So gold. So last night, gold got up to the number 212 and higher. It got up to 219, I think it was, or I'm sorry, 1119, pardon me. It was as high as 1119.10, and then it backed off, but we stayed above the 1105. That's important. Okay, so now we have to see how the market reacts over the next few days, and we really have to see gold get above and stay above 1112. So that was a good one because I was telling you down here that I didn't like the bearish case, and I explained why, and we only closed below 1089 one time, and then we popped back up, and this day I started telling you there's a bid under the market, and then I started telling you what to look for. So last night we got to the 1112, and or sometime early this morning in the wee hours of the morning, I believe, and we got as high as 1119, and then it backed off, but we stayed above 1105. That's important. We've got to get above 1112 and see how the market reacts at that number to put in any kind of a sustainable rally. But this was the first sign that the bottom may be in. The August bottom I was telling you about may have come at towards the end of July down here at 1072, pardon me. And that's fine. And that would mean that we probably are in for 2 or 3 months of upward movement, not to say it's straight up. The market doesn't move straight up. It doesn't move straight anything. You can anticipate, stuff like this, okay? There's nothing wrong with, that's very sloppy, but there's nothing wrong with, these ABC patterns and those type of higher highs and higher lows, and there's nothing wrong with that. That's the way markets behave sometimes. Sometimes they go sideways, but the higher lows and the higher highs are bullish behavior. A market like this, okay, is fine. It's a bunch of ABC patterns. That's better. So you have your higher lows and your higher highs, and the market could trade in a channel up like that, or it could just spike higher. We don't know exactly what's going to happen yet, but the point is now we're watching the important 1112, and we're going to leave it at that for tonight on gold because there's really nothing else to discuss. As long as we're above 1105, we're looking bullish, okay? That's what I can say. And for those of you that like to play the GDX, you can see here that we may have carved out a low here. Now, this is an important day here because it was on volume, and you took out a lot of days of downward, sideways to downward pressure in the market. So now that we're above, the red line is the 20-period moving average. If you wanna trade the GDX, you can, but you have to pick an important low. And right now, the real low that you would have to use as your stop out would be 1336 as a daily close below 1336. Now that's $1.20 away, and that's a little bit long in the tooth, or that's a little bit long for my liking. But where's the upside? Well, here's the deal. You're going to come up with a lot of resistance in this area here. okay, first, sorry for the squiggly line, that's called gap window. And then this would be filling the gap here. Sorry for the line again, I'm sorry. Can't draw it with my mouse. And this area here, let me just take it away and I'll give it to you. The low here is 1537. So there's not that much on the upside before you run into a lot of resistance. But if you can get through there, you can probably get to 16.5, maybe even $17 if you get a rally in gold. You've got to get the rally in gold for this to happen. So I just wanted to make mention of the GDX because I know there's a lot of folks out there that like to trade in the GDX. Okay, let's go over to oil, which I did forget last night, but it's a good thing because here's what I would have said, here's what I said in the email, and here's what I said the night before. Regardless, here's what I said the night before. We're looking for a reversal day, but that's not the trade. We have to see how the market reacts from the reversal day. And you can go back to Friday's video to hear me say that. Yesterday, I forgot to discuss oil, but I wrote that it was a reversal day, and it was a bona fide reversal day because it was a what we call an engulfing candle. You basically went down below the low of the day before and finished around the highs of the previous day on volume, more volume than we saw in any of the prior days of recent. So that's a bona fide reversal day, but that doesn't by in and of itself mean higher prices. And then I wrote to you, let me just go see what the number was. I said to you, where is oil? Crude. 45.75 to 46 was going to be all I thought it could muster on the upside, and I don't even think we got there today. We had a little bit of a spike earlier, 45.34, and then we failed and came down to where we are now, 43.18. Now, that's weakness, folks, because what we did today was we put in a reversal day from the reversal day. All right, so all this is telling us is not necessarily that lower prices are coming, and they most likely are, but all it's telling you is that the oil complex is very weak, or crude oil is very weak, and it's not anything you really want to try and pick a bottom of. And that's the reason why on Friday I said what the reversal day would look like, and we got it yesterday, but that was also the point I was making. Don't hop on just because it was a reversal day. You have to see follow through or a pattern develop from the reversal day. It's one of those things where I know it when I see it, and I point it out to you. And if we got follow through today, I would have pointed it out, and I would have told you whether it was something that we're able to trade or not. But fair enough, we got nothing. We got a failure, and we didn't even get to where I thought we would get to, which was the 45, again, I already forgot the enough, 45.75 to $46. We didn't even get up that high, which we really should have. So this market is very, very weak. Don't try and pick a bottom. There will be a short-term bottom, there will be an intermediate-term bottom, and there will be a longer-term bottom. And we're nowhere near the longer-term bottom. This is a deflationary signal in the markets, and we've been experiencing deflationary signals for quite some time. I don't talk about it a lot, only because it doesn't really, it's nothing we can trade against, and it has nothing to do with anything we do on a day-to-day basis. But just as a point of reference, deflation is when you see commodity deflation, when you see asset deflation, and what we're seeing is rotations, okay? You'll see the stock market deflate. You're seeing oil deflate. You'll see real estate prices deflate again some point in the future. These are big cyclical events. We saw deflationary forces in 2006, 2007, 2008, into early 2009. And then the Fed reflated the markets and everything reflated. But the bigger picture, the long-term picture, that 10 to 15 year cycle is deflationary. Maybe 20-year cycle is deflationary. What you saw from early 2009 up through the next 5 or so years was the Fed reflating the markets, reflating asset prices. But only did we finally see the stock market of recent make new highs. The NASDAQ recently made new highs. Most people's real estate did not make new highs. That's probably not going to happen in most cases, okay, unless you bought something at a really great price. But if you bought a house in 2005 or 6, you're not going to see those prices again anytime soon unless you got lucky or bought at a really good price. Okay, these are all deflationary forces that take long periods of time, long cycles to take place, and there's very, very stout rallies and sell-offs in the middle in all these asset prices. So it's nothing that I like to discuss on a regular basis because it's nothing we can really trade against. I thought I would just make mention to it, but this is a good example of deflation. In fact, let me show you a different picture of oil, and I'll show you deflation. In fact, I think I have, yeah, here it is. Watch this. Okay, this is a continuous contract in oil that'll give you a better picture. Okay, look at this. Okay, here's where we made a high. This was up when oil was in the stratosphere, and this continuous contract gets stitched together. So I think the high back then was 147. This looks different because it's a bunch of different monthly contracts stitched together. So don't pay attention to the actual prices here so much as just the chart pattern. This is where oil peaked out. This is where it went down. All we did, and look at this. How many times have you seen me do this on every single chart we ever look at? Okay, that has a pattern like this. Down move, sideways consolidation, and down move. Okay, this is a multi-year chart dating back from the high in 2008, okay? A multi-year chart. All we did was make a down move, sideways consolidation, and in the middle, we went all the way down, and forget the numbers on this chart. We went down to 30 bucks or something like that down here, and we went back as high as 100 or whatever the number was in 2011 or 12. And then all we've been doing is working lower. So when you pull back the chart to a monthly basis to look at it from a very long-term perspective, you can see that all we've been doing is consolidating to go what? Lower. Okay? So you see, whether we're looking at a chart on a 10-minute basis, a 60-minute chart, a daily chart, a weekly chart, they're all the same. It doesn't matter what the time frame is. They all trade the same way, no matter what. Oil, stocks, gold, any other commodity, a currency, it doesn't make a difference. They're all the same. All chart patterns have a tendency to trade the same way. And that's all I wanted to point out to you, that this is deflationary. Down move, sideways, down. You've seen me do that hundreds of times, if not more. Okay, let's move on. I know I got off on a tangent tonight, but these are lessons that I think are important, and I hope that, I know a lot of you appreciate them, and I hope that you do, because it's important stuff, and it helps you in the long run to, how you look at things. Okay, let's go to the daily chart of the TLT. Let's make sure we don't forget any markets tonight. And not surprisingly enough, today we got another rally in the bond market. And that's not surprising with the sell-off in the stock market. So all this down move from yesterday looks like a blip, right? So you can do this, okay? We can do this and say that these are, A, B, C, and then this is A, B, C, and then this is A, B, and who knows, we'll see what's next. It could continue higher or we can get another pullback. But like I showed you before, and there was a method to the madness, all this is moving higher in an upward channel, making higher lows and higher highs. That's really all that's going on. You can look at these things in 3, 4, 5, 6 different ways, and you come out with the same answer. The charts will always tell you what's going on. As long as you know where you're wrong and you know where your bottoms are and you know where your tops are, then you're able to trade in these environments. And right now, this market is in an uptrend until proven otherwise. Now, if I wanted to get more granular and I wanted to do it differently, I can do something like this. Okay, let's just take a low, okay, and let's connect some areas. Okay, and this would be a better trend line, and it's not me drawing in the trend line, it's the market, okay? And let's even draw in the other one. All right, so I know we're doing a lot tonight, but we're learning. We're learning. I love to teach this stuff, as you can tell. So we'll draw in the other trend line, and we're making. Well, that's not a good one. That's not valid. It has to be straight. Okay, so let's take that off, and let's do it like this. And this isn't an exact science, folks. You kind of, you know what? I'm going to do it like this because I'm not sure that I can do it with the straight line on the charting tool I have. But let's just do it like this. It's a rough line. Nothing's perfect. This is not a perfect world. These aren't perfect charts and perfect markets. This is an example of a channel. It doesn't mean it can't pop out of the channel and back in, just like we saw in natural gas, and it doesn't mean it has to be to the penny. This is a way markets trade, higher highs and higher lows. So what you have here are higher highs and higher lows. Okay, and this is inside of a channel working its way higher. And I suggest that you're going to continue to work your way higher. That doesn't mean we can't go down and up again or just up again. We'll see. I don't have anything for tomorrow in particular in the bond market, but I will tell you that under normal conditions, if the market is up tomorrow, you'll probably get a slight pullback in the bond market because the bond market was relatively strong today. And if you want to look at an hourly chart, you can see here, in fact, the 10-minute chart is even better to show you. You can see how much we were up today. We gapped higher, and it was just basically a trend higher all day. Okay, just similar to the stock market. It was trading very much in concert with the stock market. So higher highs, higher lows for the bond market until proven otherwise. In fact, unless I come out with a different number, here's what you can probably expect for the short term, okay? This number here at 160 that I gave you several days ago as a target, okay? And we're coming close. We were up here today at 159.11, okay? We're going to hit 160 most likely and maybe higher. Once we get to 160, the market will most likely back off. And then how we react off that 160 is what I'll be able to tell you the next move is. So right now, this is putting in, a pattern that just warrants 160. It's 160 should be a magnet for the bond market, and that's most likely going to translate to this red line at 126.50 in the TLT. And once we see how the market gets to that price point and how it reacts from that price point, we'll know whether that's going to be a top for a while or just a way station for higher prices, maybe 127.25. We'll see. But I don't have anything imminent for the bond market, but when I see a pattern develop that we're able to trade, I will certainly let you know about it. Okay, the dollar. The dollar was basically up and down today, didn't do much. Nothing going on there, and that's a little bit surprising with the rally in the bond market and the sell-off in the stock market and the fact that the Chinese currency news, you would expect the dollar to have more of a wider range today, but nothing really happened unless they're showing me tomorrow's price. No, that's today. So, all I can tell you is, to me, this is evidence that the dollar is putting in somewhat of a short-term bottom, and or it could even be longer term, but I think it's probably just a short-term bottom. But you can see the same thing. We're making higher lows and higher highs in the dollar. If you just pull back and look at it from a little bit longer-term perspective rather than day-to-day, you can see here we're in an upward channel, okay? So as the market moves upward, we continue to make higher lows and higher highs. So this is a doji candle. It's generally based on time and basically, 2, 3, yeah, I mean, it really needs a little bit more time in terms of putting in a doji to make an up move, but it could certainly be tomorrow and or the next day. I would expect upward momentum to begin in the dollar for a little while, a few days. So I'm going to expect a little bit of higher prices to come in the dollar over the next, sometime during this week. I would expect to see some upward movement in the dollar. These doji candles are normally a tip-off, along with other factors, of a trend change. Not always. I'm using those with other things that I use to read the charts. And I'm just suggesting that we'll probably see a trend change in the short term in the dollar in the near term. Okay, let's go to the natural gas market and then we'll give it a wrap. Higher prices, staying in the range. For those of you natural gas traders, you need to be aware of this candle here. This candle here should provide at 2.89 or 2.8 or 2.90, okay, is the high of this candle here. That's going to be a fair amount of resistance if we continue to move higher. But you can see, same thing like I showed you with the channels, higher highs, higher lows, and the same thing applies, by the way, if you have a channel in the other direction, okay, of lower lows and lower highs. Okay, if a market is doing this, okay, it's the same thing on the way down as the way up. Okay, this one, all this is doing is sideways. Okay, and sideways markets are going to break in one direction or another. Once we break out of this channel, it will be in one direction or the other, and it's very easy to know. When you have confirmation that you're out of the top end or the bottom end of this channel, we'll talk about it. Now, we started to get confirmation we started to break out of the channel a couple of times, as evidenced by this area here, okay, and then this area here. However, we never got confirmation, and my confirmation signal is, at least for the time being, going to remain somewhat of a secret. I have to maintain a couple of things that I just don't divulge to everybody out there, because it's normally what gives me a little bit of an edge over most everybody else. But we never got confirmation down here, and we never got confirmation here. And until those things happen, we stay inside this channel and until further notice. So right now, the likely scenario is we're working up to the top end of the channel until proven otherwise, as long as this, doesn't provide too much error, too much resistance. And if we get to the top end of the channel, there's a high probability that we'll just go back down again, because I don't think this natural gas market is poised to break out to the upside, at least not anytime soon. And we'll just play it by ear and see what happens, and I'll just keep updating you as such. So with that, folks, if you have any questions, and I know some of you have been emailing me, and it's perfectly fine. I'm happy to answer the questions. Feel free. I understand there are difficult waters out there, right? You wouldn't want to be on a small boat in a big storm in the middle of the ocean, and that's kind of the way these choppy markets are. It can be very dangerous, so be careful. Put your life vest on. Keep your money in your pocket if you're nervous, and I'll do the best I can to keep you informed the best way I know how. I'm David Frost, My Strategic Forecast. Thanks for tuning in for another episode of Common Sense Market Analysis.